So let's go ahead and get started. Good afternoon and welcome to an in-training webinar from In Alliance. This is one in a series that we're conducting exclusively for Illinois Main Street Program and its communities. My name is Darius Bryjka. I'm a principal with In Alliance. And because May is National Historic Preservation Month, this is the second of two preservation-based topics that we've covered this month. Last week's webinar was about the National Register of Historic Places, historic designation, and the importance of that. And that actually ties in to this session. So if you missed it, you can access the recording of that webinar from the Illinois Main Street website. Or if you can't find the link, you can contact me and I will provide it to you. But today we'll talk about historic preservation financial incentives, and specifically incentives that are brick and mortar incentives that assist with rehabilitation of historic buildings. And so the intent is to provide you with information not so that you can take the tax incentives, but so that you can work with building owners and municipalities in your towns to advocate for these resources, to promote them, because they are available and they tend to be underutilized. Before we move on to the topic, a couple of housekeeping items. We're using the GoToWebinar interface, so you should have a dashboard on your screen that will allow you to choose one of two audio options. One is the mic and speakers of your computer or laptop. The other one is a telephone. You can dial in and listen in that way. Additionally, you can ask questions. And there are also two ways of doing that. One is to raise your hand in this traditional classroom type manner. However, I would prefer it if you typed your questions into the questions box, and we'll answer those questions at the end. I find that the trying to answer questions throughout slows the whole thing down, and we may run out of time. So in order to stay on time, let's just answer the questions at the end, and I hope that's okay with you. The webinar is being recorded, so after it's over, you will receive a follow-up email with a survey, brief survey, a follow-up survey, and a link to the recorded webinar. Okay, so that's housekeeping. Now let's talk about incentives. I've grouped available incentives into four general categories. The first is federal rehabilitation tax credits, which we'll talk about at great length. Local incentives are just that. They're incentives that are developed at local level. They could be TIF funds, which cover both planning and brick and mortar type projects. They could be facade improvement programs that many of your local Main Street programs offer in partnerships with lending institutions, banks, or municipalities. And those are very important, but they will range from community to community. Low interest loans are available at many levels, and those are still available, and they are useful in bridging the financial gap. And then grants. Most people think that there are a ton of grants available to pay for building restoration and rehabilitation, and that simply isn't the case. Grants, first of all, they're very competitive, but secondly, they're mostly available for planning grants, and they're also available primarily for public and non-for-profit institutions, and they tend to be tied to specific building types. Having said that, there are some funds available from organizations like Landmarks Illinois, which is our statewide non-for-profit organization, or the National Trust for Historic Preservation. They tend to be smaller grants, again, geared towards planning opportunities, developing feasibility studies, historic structures reports, or potentially some very small repairs. and they're just a few $1,000s. I don't want to discount the importance of these grants because having a completed planning document does open up additional funding opportunities to. There are a couple of grant opportunities, one through the Jeffers Foundation that can provide substantial brick and mortar assistance, but it requires a completion of a planning study beforehand. But these, the latter three categories are, again, sort of inconsistent. They vary from community to community, from region to region, or they're highly competitive. What is available to everyone are federal rehabilitation tax credits, and these are for historic buildings and non-historic buildings. And in fact, a couple of these tax credits can be combined to use on a single project. These are non-competitive, so as long as the applicant meets all requirements or criteria, the tax credit will be awarded. So it's a very reliable and achievable incentive, and I'll go over the available tax credits that form the backbone of historic preservation rehabilitation opportunities today. Just a few general principles about tax credits before we talk about specifics. Tax credits are applied to an owner's federal income taxes. So the current sort of balance that's owed or to future tax liabilities, they don't have to be utilized in a single year. Eligible owners may be individuals or businesses that own the properties, so it could be a corporation, an LLC, but they must pay federal income taxes. So obviously if you don't have federal tax liability, then that becomes less of an incentive, but there are also other opportunities for syndication and selling tax credits if they are of a substantial amount. So the way the programs work is the credit is worth a percentage of the renovation cost. So as an example, under the 20% tax credit, if your project consists of $100,000 in renovation costs, that will net you a $20,000 of credit that again applies to your federal income tax liability. The other thing to keep in mind is that you can't take a deduction and a credit. You have to choose which is more beneficial to you. So no double dipping, unfortunately. Now the general sort of consensus or common wisdom is that dollar for dollar credit is better than a deduction. However, if a deduction puts you in a lower tax bracket, that may be more beneficial because it lowers your overall tax liability. So most of the time the credit will be better, but you really have to evaluate it on a case-by-case basis. Now that sort of completes my not discussion of tax credits, but this is my disclaimer. I'm not an accountant, so you really have to work with your accountant to figure out what works best for you for the specific project. We can talk about general concepts and principles, but consultants or accountants' involvement is simply invaluable. So the first credit we'll discuss is the 50% disabled access tax credit. It is for all existing buildings. They don't have to be historic. So that has the historic designation doesn't come into play here at all. Any existing building qualifies. It is for small businesses, and small businesses are defined by the IRS as having less than $1 million in gross receipts or fewer than 30 full-time employees in the preceding year. That grabs a lot of our Main Street, a vast majority of our Main Street businesses. The credit is available for handicapped accessibility improvements such as ramps, restrooms, elevators, sidewalks, walkways, redesign of entries, interior circulation, anything that improves handicapped accessibility of the small business. And the work must meet current ADA standards. ADA is Americans with Disabilities Act. Something to keep in mind here is that things like restrooms, for example, if they're handicapped accessible, you can count the cost of the entire restrooms for the purposes of this credit. So it's not just the very specific items per se that relate to handicapped accessibility. You can expand it to include entire features that are handicapped accessible. Eligible expenditures for the 50% credit are between $250 and they cap out at $10,000 and $250. So since it's a 50% credit, that means that the maximum credit you can receive is $5,000. However, you can take it annually. So this is $5,000 per year. Now, why does that matter? Well, you can spread out your handicapped improvements if they exceed $10,000 over a number of years. And this is useful especially for elevator projects. They tend to be expensive anyway. So for example, at the end of a calendar year, you could do some elevator work, perhaps build the shaft for the elevator, and then get $5,000 for credit for that. And then the following year, in January, February, whatever, purchase the cab, and then when you file your taxes for that year, you can get another $5,000 for that portion of the project. So you can take it every year. As I mentioned, some of these credits can be combined. This is one where it is. That's exactly the case. The 50% credit is for non-historic and historic properties. So, for example, if you were to combine it with the 20% historic tax credit, you would separate your handicapped improvement costs from the rest. And since you can get a higher return on those, or a higher amount back, 50% versus 20%, you can take the 50% credit on that and take the rest of the work, apply it to the 20% credit. And you can do the same with the 50% and the 10% credit, which I'll be talking about next. This program is overseen entirely by the IRS. There is no review by the State Historic Preservation Office, or IHPA, Illinois Historic Preservation Agency in this state, or the National Park Service. And it is Form 8826 on the IRS website. Here is a link to it. It is a very simple, well, I shouldn't say simple because it is an IRS form, but it's a one-page form with one page of instructions. So it's relatively simple and easy. How about that? And again, you would just include it with your annual tax returns. So on that same form, there is an option to take a deduction. Remember, we talked about deduction versus credit, which one's more beneficial. Well, here you have an option, and your accountant can assist you in figuring out what's better for you. But you can take a deduction instead of the credit. It would be the architectural and transportation barrier removal deduction, which is of $15,000 per year. So it's either $5,000 credit or $15,000 deduction. That's what I have on the 50% credit. And again, we'll take your questions at the end. The next credit I wanted to talk about is the 10% rehabilitation tax credit. It is for non-historic buildings built before 1936. Another non-historic tax credit. Non-historic means that properties are not listed in the National Register, or if they are within National Register District, they would be considered non-contributing resources. The reason why it's built before 1936, it's because that law was established in 1986, and rather than having a 50-year sliding criterion, it was written to say buildings built before 1936, so it's been stuck in that mode ever since. But there are efforts to change it and bring it up to date, which would include 30 additional years of buildings that would be eligible. The credit is available for income-producing commercial properties. So for depreciable buildings, rental residential does not count, and owner-occupied housing doesn't count either. Those are ineligible costs. And eligible costs include architectural and construction costs and depreciable soft costs. And depreciable soft costs can include architectural and engineering fees, survey, legal fees, development fees, and construction-related costs. Ineligible expenditures include acquisition costs, so you can't count the purchase price of the property. Furnishings, because they can be removed. Additions do not count, and landscape and site improvements don't count. So they have to be expenditures within the footprint of the building itself and spent on the building itself. And additionally, a building must pass a physical retention test. And essentially, IRS wants to make sure that there is an existing building that's being rehabbed rather than a new building being constructed. So the physical retention test consists of making sure that 50% of exterior walls remain and that 75% of exterior walls remain as exterior or interior walls. And additionally, 75% of the building's internal structure must remain. So things like if you have columns and joists and obviously those would count towards the structure. So before I go on to the next slide, I wanted to mention that this credit is for, again, for non-historic buildings. So if a building is considered historic, it only qualifies for 20%. And so the 10% and the 20% credit are mutually exclusive. There is a minimum expenditure test. This credit is for substantial rehabilitation. So an owner would have to spend $5,000 or the adjusted basis of the property, whichever is larger, during a 24-month period. Adjusted basis is defined as the purchase price of the property minus the land value. So we're trying to get to the worth of the building itself. You factor in depreciation and you add in capital improvements. So if you've owned the building for a long time, your adjusted basis is going to be low because it would have depreciated. If you've just purchased it, it's going to be more or less the purchase price without the land value. But so it's for substantial rehabilitation. This is another one that's very easy to take. It's administered entirely by the IRS, no review, no historic review by the state or the federal government, and it is Form 3468 on the IRS website, and here's a link to it with, it comes with instructions. Pretty easy to take, so, and a lot of people just simply don't know about this. But the backbone, if you will, of historic preservation rehabilitation is the 20% rehabilitation tax credit, which is obviously twice as lucrative as the 10% credit. And it has very similar requirements and allows for a lot of the same things. But the federal tax credit is a very powerful economic tool that over the years has created 2.2 million jobs, saved almost 40,000 buildings, and attracted $100 billion in investment to communities nationwide. For every federal dollar of the credit, it leverages $4 of private investment. So that's a pretty decent ratio, I would say, and I hope you would agree. And it can be used towards a variety of different projects for adaptive reuse type projects like this historic hotel that's converted into mixed use. These are rehabilitation tax credits, so that it's not about restoring buildings to their original appearance or original use. It is very flexible, and it really has been a wonderful program over the years. So it is a historic tax credit, and hence it is for certified historic structures, and those are defined as listed in the National Register of Historic Places, either individually or as contributing buildings within National Register districts, or contributing buildings within a local historic district certified by the National Park Service. Most of you will be in the former category and not the latter. There are very few certified local historic districts, especially in Illinois. It is, again, like the 10% credit for income-producing properties. However, unlike the 10% credit, rental residential is an eligible use. So that's huge. It's a huge distinction as we're trying to bring back housing downtown. The 10% credit wouldn't work. The 20% would for that. Owner-occupied housing is still not eligible. It has to be income-producing. So if you live there, that doesn't count. Eligible costs are the same as for the 10% credit. Again, any architectural and construction costs and the depreciable costs are the same. Whatever counts for the 10% would count for the 20. You still can't count acquisition costs, furnishings, additions, or landscape and site improvements. The minimum expenditure test is the same, the $5,000 or adjusted basis during a 24-month period. However, there is an option to apply for a 60-month phased project, so a 5-year-long project. In addition to simply having more time to complete your project, construction projects can take longer than 2 years. And if you didn't have that option, you'd have to kind of slide your 2-year window to grab the largest number of expenses so you can get the largest amount of credit. But in addition to having more time, under the phase project, you can actually claim the credit upon completion of each phase. So for example, from year 1 to 2, you're doing exterior, and then from year 3 to 4, you're doing interior, and you can have, many more phases. But after you complete your first phase, you can get the credit, 20% of whatever that value was, and begin to use it before you complete the next phase and complete the entire project. So that may be useful to you. There is a 3-part application that is reviewed at both state and federal levels, and we'll go over that. And the project must meet the Secretary of the Interior standards for rehabilitation, and we'll talk about the standards as well. There is a fee for review. So the other projects, the other credit, 50%, 10%, there is no review. You just have to maintain your receipts and expenditures to an auditable standard, but nobody's going to really come and not really. Nobody is going to come and look. For this project, there is a pretty significant review. Both of these applications, there are site visits that may be required. So the Park Service charges a fee, which is it's a sliding fee based on your project cost. It's from $845 to $6,500. Projects less than $80,000 are not charged a fee, and then it goes up all the way to $3.85 million. That's where you would pay $6,500 for a project of that size. And it caps out at that amount. You can get, obviously your projects can be larger, but your fee would not be. Additional stipulation is that the owner must retain the building for 5 years or retain a prorated portion of the credits. And that makes sense. I mean, you shouldn't just be allowed to take the credit and then sell the building. You need to retain it. However, should you sell it within that 5-year time frame, then you return the prorated portion of the credit. So if you sell it after 3 years, then you would return 40% of the value of the tax credit. So it doesn't prevent you from disposing of the property. You just can't dispose it and keep all the money for 5 years. It is a lengthy process because there are reviews again at the state and federal level. So the proposed review of proposed work approval typically takes from 3 to 6 months. It's a long time, but that's why we need people to be aware of this program and know about this rather than learning about it as they're in mid-construction or near completion. And that's a role that your Main Street program can play, is simply educating about these requirements, these nuances of these programs. And if people know about it in advance, then it's not an issue. So, but because people don't know about them, then, you know, they blame the program for ineffectiveness and so on and so forth, but it's simply a part of it. It could be better, there's no doubt about it, but it is what it is. So we just need to spread the word and make sure people know about this. So for that reason, it is strongly recommended that applications are filed before work begins. I mentioned the standards. You know, it's possible that if someone doesn't know about this opportunity and is simply rehabbing their building to the best of their understanding of what they need to do, you know, they're trying to meet their programmatic requirements, and then they learn about the credit and they apply, but they've already done something that shouldn't have been done. They've removed an important feature, destroyed it, and that would result in a denial of the application. So, but if you submit before, and then you can avoid those kinds of situations. Again, ignorance is no excuse. So the application itself consists of 3 parts, as I mentioned. Part 1 of the application describes the physical appearance of the exterior and interior of the property, not in great length. It's just a few paragraphs. It's a 2-page form. One page is for contact information, project info, and the second page is for these descriptions. So really 1 page is sufficient for this purpose. And then you also provide a very brief narrative on the history and significance of the property to the historic district, which you could generally take from the National Register nomination. You do submit some photos of the property with the Part 1 site plan, which can be very simple. Just information that will allow the reviewers or the Park Service to determine that your building is in fact historic. Now, Part 1 is not needed for individually listed properties. It is only needed for contributing buildings within National Register districts. So that's important to remember. And the very, very critical component of this is that the Part 1 of this application must be submitted prior to placing the building in service. This is something that if it doesn't happen, you simply can't do anything about. The reason for this is that because Part 1 deals with evaluation of significance, the determination of whether your building is historic or not, if the Part 1 is not submitted, it would be interpreted that the work was done on a non-historic building, and the building is not a certified historic structure until it is determined to be one by the National Park Service through this Part 1 process. So, yes, it's possible to apply for the tax credit sort of after the fact or as you're already in mid-construction, but if you don't submit the Part 1 before the project is finished, then it's too late. You can't go back. So unless it's a individually listed property, which since Part 1s are not needed for individual lists, then that would be okay. All right, so here's how the part one looks, or the second page of it, so you can see the description of the building is, 3 short paragraphs, some dates of construction, statement of significance, nothing extensive, and again, most of it can be gathered from the National Register nomination itself. This, by the way, comes from a publication by the Park Service. It's called the Introduction to Federal Tax Credits for Rehabilitating Historic Buildings, and this is for Main Street commercial buildings. They have separate publications for different building types. The other building types that they have produced this for barns, row houses, and wood frame houses, but I think the Main Street one is the most useful. So so that's what your part one would consist of, these descriptions, photographs of the building, and maps. Now, I did want to mention that even though this is 4 buildings already listed on the register, it is possible to pursue the tax credit while simultaneously pursuing the listing on the National Register. Now, this is a slightly more complicated scenario, so I'm not going to fully explain it, but this part one is still very critical, and what you would do in this instance is submit a draft of the National Register nomination with the part one. And then if that got approved, then you can proceed with your project. You can actually claim the tax credit before the building is listed on the National Register. It would have to be listed within 30 months of completing the rehabilitation of the building. Then if it weren't, then you'd have to pay the money back. But so it is possible, it is doable, but again, it's slightly more complex, and you have to really work with deadlines and have the draft of the nomination completed in a certain time. And the draft nomination is essentially a full nomination, unfortunately. So, but I digress. It's probably too specific information for today. So after your building is approved for the part one, it's determined that it is historic, that it qualifies for these credits, then you would describe what you want to do to it, and that occurs in the part two, where you describe the condition of the building prior to rehabilitation. Then you say what it is that you're going to do, and you show photographs of exterior, interior, the site. The more the better. The state reviewers from IHPA will come to the site, but the people at the National Park Service, the reviewers there, will not. So they will be evaluating your project simply based on photographs and comments from IHPA. But so, consider these photographs as being the walkthrough that these people have of the property. So the more the better. Architectural plans or drawings are not required, but if they are available, they are helpful because they obviously explain what changes are occurring, what walls are being moved, what openings are being put in, what material changes are occurring. So if you have plans or any type of drawings or details or specifications, you should include them. That's going to aid in the review process. The key to remember here is that you provide descriptions and photographs of all features, not just those that are qualifying for the credit or that you are actually altering, but you need to describe things that you're not touching at all, so they know that. If you show them photographs of this wonderful building with all these ornamental features, and then you're only describing one thing, they're going to come back and say, what are you doing to this, this, and that? So you might as well take care of that in the beginning and assure them that you're not touching this or doing this. It basically has to be as complete description as possible. And even if it's redundant, that's fine. So here is how a part one, or part two rather, looks. You on the left-hand side, you describe the existing feature of the building, and you can key it to drawings and photographs, and then you describe what you're going to do to it. And You do it in a very detailed but concise manner, provide the relevant information. Keep in mind what this review is trying to accomplish. They want to make sure that you're not destroying the historic character of the property. So, and this example comes from that same publication I showed you earlier. And after you've completed your work, well, after you submit your Part 2, hopefully you'll get it approved. That gives you the green light to do the work. After you complete it, before you get the tax credit, you have to submit the Part 3, which essentially consists of photographs of completed work. And it would make sense that the views that you took in Part 2 of existing conditions are replicated in the Part 3 photographs, so they can see from these same angles, same viewpoints, what you submitted earlier. And you label them, number them, date them on the back, and the Part 3 can be sent on. The photographs are very important, so I just have a few additional points about them. They should be good quality. What does that mean? Well, they should be legible. If they're fuzzy, they're not terribly useful. They should be in good lighting if possible. They should be sharp. They not overexposed or underexposed. Most digital cameras do a good job, but there's still doesn't compensate for a bad photographer. They don't have to be professionally taken, but just keep in mind, you're showing photographs of buildings that these people will never see in person. So, show overall photographs before you show details. And, details alone aren't going to convey the full story of what's going on. So, keep that in mind. They can be digital, but you can take them digitally, but they must be printed, and you would submit 2 sets of everything throughout this process, 2 sets of the forms, 2 sets of the photographs, 2 sets of the maps. One is for the state reviewers, and one is for the National Park Service. You label and number the photos consistently, keying them to the parts 2 and 3 descriptions, and if needed, if there are really a ton of photographs, you can key them to a floor plan, so you're showing with little arrows and numbers, where your photographs were taken and in which direction your camera was pointing. This is another key point, is that the burden of proof lies with the applicant. So you need to document the property extensively before beginning any work. This is another thing where you learn about the program or the tax credit after you've already begun and you didn't take photographs, and you swear that the windows that you took out were not historic. They were already replacements, or that there wasn't anything historic on the interior, but you don't have any documentation of that. That may result in denial of the project. You have to have evidence to support your case, or you're saying that these windows were broken, or that this brick was beyond repair, or this wood post or column the staircase was beyond repair. You have to show some documentation or proof of that. So, and documenting the property is the key to doing that. So these are the requirements, and then the final one, not the final one, but the one that people find the most difficulty with, is meeting the Secretary of the Interior standards for rehabilitation. I find the standards quite reasonable and common sense, and they are very flexible. But this is, again, may result simply in a lot of people applying for these programs in mid-project and not having the benefit of the initial review. But the standards are nationally adopted concepts about maintaining, repairing, replacing historic materials, and designing additions or making alterations, and they allow for these things, for replacement and for additions and alterations. They're not restoration standards, they're rehabilitation standards, a very, very important distinction. So I'm not going to go through all 10 standards, but just very briefly, let's try to get a sense of what the standards say. They tell us that we should retain and preserve the historic character of a property. So if you have a building like this, if it has a lot of historic integrity, such as starting at the top, the cornice, the window hoods, the windows, the storefront with its cast iron columns and display windows and bulkheads, those are all important character-defining elements that should be saved. But if you had a storefront or a facade and also interior features that are not historic and not significant, then it's okay to either keep them if you want or replace them with something compatible. So what reviewers are concerned about are the primary features and spaces. So it would be the front of the building versus the back of the building. They'll still look at the back, but it's not going to be reviewed scrutinized as closely. You'll have a lot more leeway in these secondary spaces. So staircases, foyers, major rooms with, say, a living room with a historic fireplace, kitchens, bathrooms, basements, attics, even bedrooms, less significant. But these open public spaces are what's important in most situations. The standards, furthermore, the standards tell us we should repair rather than replace. So we maintain, repair first, and then if it cannot be repaired, then we can replace it, but with something that's compatible. In this example, we have historic windows at the top and the replacement windows at the bottom. Assuming that the windows there could not have been saved, is this a compatible replacement? We have multi-light sash replaced with 3 gigantic windows. Clearly, that is not compatible, and it alters the historic character of this property. It's those kinds of things that are important. Furthermore, the standards tell us we should not use treatments that cause damage to historic materials. So repointing is a huge thing, or sandblasting, abrasive cleaning methods that are damaging to historic materials. In this case, the repointing not only did visually mar the exterior of this brick, the historic mortar, if you will, is at the gable, and the light-colored mortar that has been smeared all over this building is the non-historic one, inappropriately done. But also, if the mortar is too hard, then it can be damaging to the brick as well. That's just one example of an incompatible and damaging treatment. And then standard 4 is one that's important, particularly for historic buildings on Main Street, because it discusses change over time. Very few of your historic buildings in your main streets are completely original, meaning they have features, all of the features date to the original construction of the building. Most of the buildings were altered. Some were altered heavily, some were altered less so, but very few buildings are completely intact in terms of their original features. And storefronts in particular were changed because that's where retail activity occurred, and merchants wanted to have their storefronts up to date, just as they do today. That was the same 150 years ago as well. So every 20, 30 years or so, it was common to get a new storefront. The rehabilitation standards recognize this change over time and want us to keep it. And I love that fact, because taking this, for example, we have a 1930 storefront on a 1978 building. the conventional wisdom would be to, well, let's take this out because it's not original and put an original storefront back. But how can what you put in 2013 be original to the building? It would merely be an interpretation of what we think was there, and it would consist of now non-historic materials. Whereas here, we have a whole layer of history that talks about the aspirations of this business owner, and it just adds a whole another dimension to the story of this building and then the community as a whole. And not only that, this storefront was on this building for a longer period of time than the original storefront would have been. So why sacrifice the historic for faux original? So the key to remember with rehab standards is they don't just encourage that. That is a requirement. If you were to go for tax credits on this building and if you took this storefront out, you would be denied. And you should be. So anyway, that's all about the federal rehabilitation tax credit, and I wanted to give you a quick update about the state rehabilitation tax credit. There isn't one in Illinois yet. Illinois, we're surrounded by states that have them, and they basically double the incentive because they layer on top of, they mirror the federal tax credits. So all the states around us have 20 or 25% state tax credits that if you apply for the federal, you automatically qualify for the state tax credit too. So this isn't available in Illinois yet. But there are current efforts by Landmarks Illinois, our statewide advocacy group, to pass the state tax credit. It did pass the Senate in early May. It was Senate Bill 336, and it has been in the House. I actually don't have the latest news, and unfortunately it didn't look good for it. It seems like it will probably not be approved. I hope I'm wrong, but all that means is that we'll just have to keep trying. So, and we'll hopefully get it at some point. So the state tax credit is not available in Illinois just yet. There is a pilot program that's available in 5 cities through the River Edge Redevelopment Zone program. I can't remember the 5 off the top of my head. Peoria is one. Rockford's another, and I think Elgin may be another one. So I'm missing a couple, but it is not available statewide, not yet. So what can local main streets do? I talked to you about this as if you were the building owners taking these credits. Well, if you do own a building and if you want to rehab it, by all means, feel free. But the point of this webinar is to give you the tools and information so you can make sure that people in your Main Street districts, in your downtown districts, know about this and can take advantage of it. The 10% credit and 50% credit is available to anyone. It is not tied to historic designation. And you can be a hero just by providing this information. You don't have to create new incentives necessarily. Additional things you can do. This process can be scary to most people. It's daunting. They're running their small businesses. They don't have time to do the paperwork, whatever it is. If you can, this is asking much, but it's not impossible for you to become well-versed in this process and perhaps assisting them with it. Either one-on-one or at least hosting some kind of workshop, just like what I did with you today, a webinar, a workshop, go over the facts, the pros and cons, the musts, the critical things like, you need to get your part 1 in before you complete the project, those kinds of things. Those are details that make or break projects, and you can pass them on to building owners and other people that deal with developers, contractors, architects, that don't expect them to already know this. A lot of people do not. So that can certainly be a role. And then the other one dates back to our previous webinar, which was a discussion about National Register nominations. The key to tap into the 20% tax credit and the state tax credit when it becomes available, I'm an optimist, so I won't say if, I'll say when it becomes available, is a listing in the National Register. And as we explained in the last webinar, 27 Main Street towns in Illinois do not have National Register downtown districts. So what you can do is make your downtowns eligible for this incentive. So it has really nothing to do with the tax credit process per se. You just can assist in making sure that these people can take it, make them eligible for it. 9 towns have very old districts, so those should be updated as well. And there are only 7 towns with very new districts that are up to par, if you will, that really would allow for the maximum number of buildings in those communities to qualify for this incentive. So if you want to know more about this last point, National Register, how it works, what you should do, check out the last webinar from last week. It should be on the Main Street website. I'll link to it. If not, I can send it to you. Just let me know. And here are a few links for additional information. All of this can be found on the Illinois Historic Preservation Agency's website under tax credits and on the National Park Service's website. All of the standards, different case studies, requirements, do's and don'ts, forms, all of that is out there. And then the tax-related information, the very kind of specific accounting, income, information, I should say, who qualifies, you know, your income, passive and active income distinctions, all of that stuff can be found on the Internal Revenue Service's website. My disclaimer, once again, I'm not an accountant, so I'm not telling you, you know, do this or do that. I'm just providing the information, and you still have to figure out whether your specific projects are applicable and whether you can take advantage of the incentives. But that's all I had in terms of content, and I'll just check out if you had any questions. And looks like there are a few. So one is, Elgin is a river edge redevelopment zone, so I was right. And one of the incentives is the building materials sales tax exemption. Is there any reason this can't be used in conjunction with historic preservation incentives? I don't know anything about this exemption, so unfortunately I can't answer that. But essentially the state tax credit, quote unquote, is part of the river edge redevelopment zone. So projects, so you can take that, and I think it's at 25%, so you can layer that on top of the 20% federal tax credit and utilize it. What are considered depreciable soft costs? We covered that initially. I'll repeat those to you, but you can go back into the beginning of the webinar, the recorded version. Depreciable soft costs include architectural and engineering fees, survey, legal, development fees, and construction-related costs. And the other, someone provided us with a list of the redevelopment zones. It's Aurora, East St. Louis, Elgin, Rockford, and Peoria. So if you're in those regions, you would qualify, but you still need a project within these zones. It's not within city limits. There are specific zones within these communities, and even though you're within that zone, you still have to have historic designation, aka National Register listing. And final question I see here is the building purchase covered under tax credits? No, you cannot. Those are not qualified expenses, so you can't get the credit on purchase of the building. You have to subtract that out. So, any other questions? If not, I will let you go, but thank you for attending the webinar today. I hope this was useful. And if you have additional questions, my contact info is on the screen, so don't hesitate to contact me in the future. So thank you very much, and have a wonderful afternoon.